Hello, and welcome to the webcast, FASB Update for Private Companies and Not-for-Profit Organizations. This webcast is held twice a year, typically in June and in December. Thanks for being with us today. Please note that the views expressed in this webcast are those of the individual presenters. Official positions of the FASB are reached only after extensive due process and deliberations. Next slide, please. My name is Jennifer Weiss, and I'm a supervising project manager and coordinator of the Private Company Council and the Not-for-Profit Advisory Committee. Presenting with me today are board members Christine Bodison and Marcia Hunt, PCC member David Finkelstein, Jeff Mechanic, FASB Senior Project Advisor, Jeff Gabello, FASB Supervising Project Manager, and two FASB postgraduate technical assistants, Jack Krause and Liz Vautier. There are a few housekeeping items to go through before we get started. Let's go ahead and move to the next slide, please. First, webcast slides are available on the FASB's website by clicking on Educational Webinars under the News and Meetings webpage. Additionally, we have included the link to the slides in the chat room. Next, to ask a question, please type into the Q&A box and click Send. We will do our best to respond to questions throughout the webcast. That said, for the questions that we're not able to get to today, we do have a free technical inquiry service on our website where you can submit technical accounting questions. Playback of this webcast will be made available on our website for 6 months. That said, CPE credit will not be granted to those who watch the archive. Next slide, please. Approximately 2.5 hours of CPE credit is available for viewing the live program, although CPE credit is not available for group viewing. CPE is expected to be awarded within 5 days if the following requirements are met. 8 of the 10 polling questions must be answered. Please stay on the webcast for the required number of minutes, and we ask that you please complete the course evaluation at the end of this program. On the next slide are the learning objectives for today's webcast, and that is that you're going to better understand the areas listed on the tiles here. Let's go ahead and move to the agenda. Christine is going to kick us off by providing an overview of the FASB's agenda and talk about the reconstitution of the Emerging Issues Task Force, or the EITF. Christine will also provide an overview of the post-implementation review process. Marcia and Jeff G. will talk about 3 post-implementation review projects: leases, revenue from contracts with customers, and current expected credit losses, or CECL. Then David will talk about PCC activities, as well as a final ASU on profits interest awards. Then Jeff M. will provide some information about the Not-for-Profit Advisory Committee, or the NAC, that is, its current membership and some recent activities. And then lastly, several of us will highlight 5 technical agenda projects. So before we move into our first topic, it is now time for polling question number 1. So if you could please launch that polling question. That polling question asks, did you participate in the December 2023 webcast and focused FASB update for private companies and not-for-profit organizations? A, yes. B, no. C, not sure. We're going to give participants a chance to respond here. And as we're waiting on your responses, wanted to let you know that there is a PCC meeting coming up on Monday, June 24th. That meeting can be viewed live on the FASB's website. And if you're unable to watch the meeting, a playback will be available later on our website. Materials for the PCC meeting will also be posted to our website, and that will happen a few days before the meeting. Now, during the PCC meeting, members are expected to discuss their agenda priorities, hedge accounting improvements, induced conversions of convertible debt instruments, and additionally, the PCC, they have a meeting with the FASB's Small Business Advisory Committee, or the SBAC, the day after the PCC meeting. So those 2 groups will talk about areas of mutual interest, such as credit losses, debt modifications and extinguishments, accounting for and disclosure of software costs, accounting for government grants, derivatives scope refinements, and accounting alternatives and changes in accounting principles. So with that, let's think we're getting pretty close to closing the polling question. I'll give you just a few more seconds. Okay, Let's go ahead and close this polling question out and send the results. Great. So we have a pretty good mix of folks that are returning and have viewed the prior webcast, and we also have some folks that have not reviewed or viewed the webcast in the past. So that's wonderful. Okay, Christine, I'm going to turn it over to you.
There we go. Good afternoon, everybody. And thank you very much, Jennifer. I'm going to start things off with an overview of the FASB's current agenda. Next slide, please. We have issued several final ASUs and a couple of exposure drafts since the December private company not-for-profit webcast, and we continue to make steady progress on other projects and assist stakeholders in implementing standards. This slide shows the different types and number of projects that we are currently working on, many of which resulted from the 2021 agenda consultation. Next slide, please. This slide lists the 11 projects on our technical agenda. Since the staff is in the process of drafting a final ASU for the induced conversions of convertible debt instruments project, we will soon be down to 10. During the third quarter, we expect to issue exposure drafts on 5 of these projects, specifically the Accounting for Environmental Credit Program project, the Accounting for Government Grants project, the Topic 815 Derivative Scope Refinements project, the Topic 815 Hedge Accounting Improvements project, and the Interim Reporting Narrow Scope Improvements project. In addition, I expect that an exposure draft on the Accounting for Software Costs project will also be issued sometime before the end of the year. Information about each of these projects is available on the FASB's website. Next slide, please. Projects are added or removed from the technical agenda by a majority vote of the board. The research agenda is controlled by the board chair, Rich Jones. And Rich generally uses the research agenda to gather information about whether there is an identifiable and sufficiently pervasive need to improve gap, whether there are technically feasible, cost-effective solutions, and whether the issue has an identifiable scope. That information is then used by the board to decide whether to add a project to its technical agenda. Currently, there are 7 projects on the research agenda, and Rich has directed the staff to issue invitations to comment to solicit public feedback on 3 of these projects sometime before the end of the year. Specifically, the Accounting for and Disclosure of Intangibles project, the Financial Key Performance Indicators project, and the Agenda Consultation project. Next slide, please. We also have one conceptual framework project on the technical agenda, which should be completed soon. Sometime this summer, the board will issue the measurement chapter in the conceptual framework, and this will wrap up the work on the board's conceptual framework. As a reminder, the framework is non-authoritative. It is a tool for the board to help us arrive at standard-setting decisions that are more consistent and well-reasoned. Next slide. Now, I mentioned the Agenda Consultation Research Project a few slides back. This agenda consultation process will be much like what we did in 2021. Toward the end of the year, the staff will issue an ITC asking stakeholders to comment on what the board should work on in the future. That feedback from a breadth of stakeholders, including feedback from private company and not-for-profit stakeholders, plays a critical role in helping the board decide what issues need to be addressed through standard setting. Furthermore, the PCC is undertaking its own agenda priority process, and David will talk about the PCC's process a little bit later in this webcast. Next slide, please. Now, earlier we mentioned, I mentioned that we will soon be issuing a final ASU on the induced conversions of convertible debt instruments project. That was a project that was deliberated by the old EITF, And I say old because Rich reconstituted the EITF earlier this year, including appointing 11 members to the EITF, many of whom are new. The process by which the EITF's agenda is set has also changed. External stakeholders can now submit agenda requests directly to the EITF. And agenda requests that come to the board may be directed to the EITF by Rich. The output of the EITF's deliberations will be a recommendation to the FASB to add a project to its technical agenda and ratify the EITF's proposed solution in a one and done meeting of the board. These changes are intended to expedite the work of the EITF. The newly reconstituted EITF will hold its first meeting on Friday to debate potential amendments to how the accounting acquirer in a business combination is determined when the acquiree is a VIE. Now I'm going to hand things back over to Jennifer to take us through polling question number 2.
Right. Thanks, Christine, for that helpful information. Can you please launch polling question number 2? And it asks, which of the following best describes the organization you work for? A, local CPA firm. B, regional or national CPA firm. C, private company. D, not-for-profit organization. E, user of financial statement. For example, a lender, private equity, a type of thing. Or F, other. Now, as I mentioned earlier, you can certainly ask us questions during this webcast. We'll do our best to answer them as we make our way through the webcast. And if we run out of time to respond to your question, you can submit your technical accounting question through our technical inquiry service, which is located on our website. So while we are waiting on participants to respond, I have a trivia question, and that is, which of the following groups were formed first, the Private Company Council or the FASB's Not-for-Profit Advisory Committee? Well, the answer is the Not-for-Profit Advisory Committee, or the NAC. The NAC was established by the FASB in October of 2009. The NAC is a committee who works closely with the FASB in an advisory capacity to ensure that perspectives from the not-for-profit sector are effectively communicated to the FASB on a timely basis. Now, the PCC, on the other hand, was established just a few years later in May of 2012 by the Financial Accounting Foundation, which is the FASB's oversight body. With that, we've received quite a few polling responses, so we can go ahead and close that polling question and send the results out. Great. Here again, we have quite a diverse mix of folks from different types of firms and organizations. So thank you again for being with us today. Okay, Christine, I'm going to turn it back to you.
Great. Thank you, Jennifer. So now I'm going to talk a little bit about post-implementation review, which is often referred to as PIR. Next slide, please. Major or significant ASUs normally undergo a post-implementation review, and this process is subject to the oversight of the FAF Board of Trustees, and the staff regularly reports on the progress of PIR projects during public meetings. There are several objectives of a post-implementation review. First, to determine whether a standard is accomplishing its stated purpose. Second, to evaluate the standard's implementation and continuing compliance costs and related benefits. And finally, to gather feedback to improve the standard setting process on a go-forward basis. Post-implementation review has 3 stages. Stage 1 begins after the issuance of the standard, and during this stage, we actively monitor the implementation process and, as needed, develop and disseminate implementation guidance and educational materials. Stage 2 begins after the effective date, and during this stage, we conduct outreach to understand the costs and benefits of the standard and monitor its ongoing application. Now, as many of you are aware, many standards require public companies to adopt first, and then a year or 2 later, private companies and not-for-profit organizations adopt. As a result, it is common for our post-implementation review work to start with public companies and then move on to non-public entities. Now, finally, in stage 3, the staff summarizes the feedback received and the actions taken by the board in a final public report, which is published on the FAB website. Currently, there are 3 post-implementation review projects that are underway. Topic 606 on revenue from contracts with customers, Topic 842 on leases, and Topic 326 on financial instruments credit losses. So with that, I'm going to turn the presentation over to Marcia to discuss the post-implementation review of revenue.
Good afternoon. While I'm going to discuss the 3 projects that Christine mentioned are currently under post-implementation review, I'm going to start with revenue, as that is the project that is the furthest along in the process. Next slide, please. The post-implementation review project on topic 606, which was revenue, is actually nearing completion. We are currently in stage 3 and expect that the final PIR report will be issued before the end of this year. Just to recap some of the previous activities that have been performed related to this project, much of which has actually been in public. There was a public roundtable held in November of 2023, and we discussed the results of the PIR with stakeholders, and that included non-public entity stakeholders. During that roundtable, we received valuable feedback on the benefits and costs of topic 606 overall. Roundtable participants agreed that this guidance achieves its expected results and benefits. Participants observed that the types of implementation costs incurred were within the board's original expectations. There were some implementation challenges, and many of those were noted. Specifically, principal versus agent considerations and determining exactly which entity is performing which function. Consideration payable to customers, licensing, and licensing is an area where some entities observe some changes in the accounting under the updated guidance. Identification of the performance obligations, which the model now requires. A standalone selling price, variable consideration, the incremental costs of obtaining a contract. Those are aspects that are important in determining the amount of revenue recognition. Short cycle manufacturing, as well as certain disclosures. Despite the implementation challenges addressed, the participants generally agreed that significant changes to topic 606 as it now stands are not considered necessary. Some participants suggested making minor improvements, such as adding illustrative examples or additional implementation guidance in certain areas. Although participants generally noted that convergence with the IFRS accounting standards should remain a priority. So while these challenges were identified, what we learned is that practice seems to have adapted to the challenges. If anyone wishes to view the meeting materials or the minutes from that roundtable discussion, they are available on our website. We will be holding a joint session, again, this will be in public, with the FASB later this month, and we will be sharing with them what we've learned from our revenue PIR process. As you know, this is a converged standard, and it's important for both organizations to be sharing at the same time to make sure that we're hearing the same messages. Let's move on to the next slide. As you can see from the tiles on this slide, the FASB has conducted many PIR activities with both private companies and not-for-profits over the past several years. For example, during stage 2, we solicited feedback from over 50 non-public entity stakeholders, and these included the users, preparers, auditors, trade groups, and advisory groups that focus and work in the not-for-profit sector. Feedback was received through a variety of methods, as listed on the tiles here, such as group meetings, surveys, individual meetings with stakeholders, and again, a public roundtable. Some of the outreach includes meetings with our advisory groups, specifically the Private Company Council, the Not-for-Profit Advisory Council, and TIC, which is an AICPA Technical Issues Committee. This feedback was presented to the board in September of 22. The meeting handouts and the playback of this board meeting are also available on our FASB website, should you like to hear more information about this. While this process on this standard will be wrapping up soon, we will continue to monitor potential Topic 606 application issues for all entities. Let's move on, please. Next slide. I wanted to spend a few minutes with the participants on this webcast and share with you the specific feedback that we've received related to both private company and NAC. I want to make these emphasis. Highlighted on this slide, you can see the different aspects of the feedback from both groups. Overall, PCC members indicated that the guidance did improve consistency in financial reporting. And while there are some smaller private companies who may still be gaining familiarity with certain aspects of 606, we were told the application of the guidance will continue to improve over time. In the box on the right, PCC members have identified several areas that they could consider addressing on its agenda. Priority process, which is a process that David will be talking about later in this webcast. These areas include presentation of billings in excess of costs and conditional retainage as contract assets and liabilities, incremental costs of obtaining a contract, short cycle manufacturing, variable consideration for long duration contracts, and sales and usage-based royalty exceptions. You'll notice some overlap between some of these topics and what we discussed earlier. And that is, again, an indication of how the PIR process can inform our current technical agendas for both the FASB and the PCC. Most of these issues that the PCC may consider relate to recognition and measurement. The first issue is related to presentation. There is a memo posted on the PCC web page, and that's from the April meeting, the most recent. And that goes into further detail about these issues, should anyone want to do some more research. Now let's move on to feedback from the NAC members. The consensus was that most preparers did not find Topic 606 difficult, and that the implementation costs for NAC, not-for-profit entities, were manageable. Several committee members, including those working with the healthcare and higher education sectors, indicated that the amount of revenue recognized did not significantly change in most cases. Membership organizations and continuing care retirement communities were more affected by the updated standard and guidance. Committee members noted that because many not-for-profits without public debt opted to apply the disclosure exemptions available to them, the benefits of the disclosures for users of those entities are limited. Lastly, in a recent NAC meeting, a few members observed that there is diversity in practice in accounting for contract liabilities and receivables related to tuition in independent schools. They noted that some schools record deferred tuition only to the extent of actual payments received before year end that are related to a future year's tuition contract. And some schools record the entire amount of contract assets and liabilities related to a future year's tuition contract. Next slide, and I would like to turn this over to Jennifer for polling question 3.
Great. Thanks, Marcia. You can go ahead and launch polling question number 3, please. And it asks, which of the following areas of Topic 606, revenue from contracts with customers, continues to be a challenge, if any? If more than one, please choose the most significant area. A, short cycle manufacturing. B, principal versus agent considerations. C, disclosures. D, other areas not listed. And E, no continuing challenges exist. Now, you've heard Marcia mention a couple of these areas already, short cycle manufacturing and principal versus agent. And Just in case you're not overly familiar with those two areas, I thought I'd take a few seconds to explain that to you. So topic 606 fundamentally changed the core principle of revenue recognition to a transfer of control model. So entities making customer specific products, including short cycle manufacturers, which are also referred to as contract manufacturers, generally conclude that such products don't have an alternative use. They also conclude that they have an enforceable right to payment of goods manufactured to date, which results in recognizing revenue over time. While under the previous guidance, short cycle manufacturers typically recognize revenue when products were shipped. And then with the second option, principal versus agent considerations, if an entity is a principal, revenue is recognized at the gross amount of the customer consideration to which the principal is entitled to for the transfer of goods or services. In contrast, if the entity is an agent, the revenue is recognized at the fee or commission that the agent is entitled to retain for arranging for another party to provide to the customer goods or services that are not controlled by the agent. So in other words, there's gross versus net reporting here. So we're going to give folks a few more seconds here to respond to this polling question. You want to make sure that you get your CPE credit, so please get that in. Continue to see additional responses, so we'll wait here just another few seconds. Okay, I think at this point we can go ahead and stop this polling question and push out the results. It looks like we've got a kind of another diverse answers with disclosures or no continuing challenges exist. Well, that's good news. And then secondary disclosures followed by principal versus agent considerations. So with that, I'm going to turn it back to Marcia.
Thank you, Jennifer. Now I'd like to take a few moments and talk about leases and what we have learned from the PIR process with that standard. Let's move to the next slide. I may have moved to the slide a little early, so you'll have to listen to me because you may not see my words on this, but a little bit of background. Since the leases guidance was issued, we have completed a significant amount of PIR activities, which frankly began right when the standard was issued. For example, in stage 1, we held public webcasts and roundtables and provided educational materials on the implementation of the standard. We issued 9 additional ASUs pertaining to leases, and this is really a result of addressing feedback that we received very early on. 2 of those ASUs deferred the effective date of the leases guidance for private company and not-for-profit organizations. We learned early on through the implementation that a number of entities were having difficulty getting some of the systems preparedness on the timetable that we initially thought would be doable. So I think that we indicated that we were responding to what we were hearing on a real-time basis. We also received on this standard nearly 400 technical inquiries. So that informed a lot of what we did. Technically, Christine talked about the process of the post-implementation review, and this standard is in what we consider to be stage 2. What we have been doing in stage 2 is gathering feedback from our advisory committees and councils, including both PCC and NAC. And we've also been conducting specific outreach with various stakeholder types. We're still in stage 2, and this process will continue to gather feedback from the non-public entities on the standards implementation and the associated benefits and costs with their users. It's reasonable that this project, because of its effective date and because of the delays in the effective date, is at a different stage at this time than the revenue standard that we just discussed. Later this month, in our joint educational meeting that I already referenced with the IASB, we will be sharing what it is that we have learned. And in the second half of this year, we will ramp up our efforts performing outreach with non-public entities to get additional feedback. The timing for stage 3 is still being completed. So now the slide that you are looking at talks a little bit about, now we can move forward. There we go. There we go. This slide summarizes the recent feedback from the Private Company Council about LISA's implementation. PCC members identified several areas of the LISA's guidance that continue to be challenging, especially for smaller companies. While Topic 842 provides some relief for private companies in certain areas, such as a practical expedient related to common control arrangements, PCC members have indicated that additional simplifications, such as practical expedients or alternative for private companies, should be considered. Additionally, the PCC received feedback from a group of lenders who indicated that information in the notes pertaining to related party leases is sometimes lacking. Therefore, this is a good opportunity to remind webcast participants about the required disclosures in Topic 850 of related party disclosures. Those required disclosures do include related party leases, so you may want to refer back to Topic 850 as you are preparing or auditing financial statements to make certain that you are complying with those requirements. PCC members also noted that there continue to be challenges in determining the incremental borrowing rate. Lastly, since Topic 842 has been implemented, there have been more detailed conversations between lenders and borrowers about the information reported in the financial statements. Some would consider that to be a benefit. Next slide, please. Now I'd like to talk a little bit about what we received from NAC. We always have a standing agenda topic when NAC meets, asking for feedback on implementation of recent standards. Building upon the discussion that occurred at the September NAC meeting, when NAC last met in March, committee members discussed their experiences implementing this standard on leases. Specifically, user members noted that information resulting from the application of Topic 842 provides enhanced transparency about lease transactions, both on the face of the statements and in the notes to the financial statements. User members commented that they are seeing diversity in practice in the presentation of right-of-use assets. Some not-for-profits present these assets separately, while others include them within PP&E. Lastly, practitioner members questioned whether educational guidance would be helpful to clarify whether renewal options existing in sale and leaseback transactions should be considered in the same manner as repurchase options. Now I think, Jennifer, it's time for polling question 4.
Yeah, thank you, Marcia. Let's launch polling question number 4, please. It relates to leases. So which of the following areas of Topic 842 leases continues to be a challenge, if any? If more than one, please choose the most significant area. A, embedded leases. B, lease modifications. C, lessee allocation of fixed and variable payments. D, other area not listed above. E, no continuing challenges exist. Now, as Marcia was talking about the leases post-implementation review, she mentioned that we are currently in stage 2 and that we would be ramping up additional activities pertaining to non-public entities later this year. And so I can talk a little bit about what we expect to do with respect to non-public entities. We will continue outreach with preparers and practitioners about ongoing application of the LISA standard. We will also perform outreach with investors in private companies, not-for-profits, and actually also public companies, kind of do a refresh of the outreach that we've done in the past. We will plan to conduct a survey for private companies about the initial and ongoing cost of implementation, as well as consider relevant academic research. So let's see how we're doing here. We've only got about 92% of folks that have responded to the polling question, so please do so now before we, I don't want to close it just yet. I know CPE credit is very important to you all. Keep those responses coming in. Okay, give you about another 5 seconds. Okay. Looks like most of you have responded, so we will go ahead and close that poll. Thank you for the responses. Okay, with that, I am going to turn it back to Marcia, talk about credit losses.
Thank you, Jennifer. The last thing I'm going to mention briefly is current expected credit losses. And I know that Jeff Gabello is going to follow me and talk a bit more about this standard and its requirements. What I'm really addressing here is what we've done since the standard was implemented and how that affects and how that's responding to the feedback we've received in our post-implementation review process. We received feedback after the standard was issued, and there were some financial institutions that were going through some business combination transactions. We received some feedback that indicated that with the new CECL guidance in place and combining that with the business combination guidance, there were some that were questioning the meaningfulness of the resulting financial statements and what we would call the day two reporting once you applied CECL to acquired assets. Here are some specifics, and I realize that this may be a little bit industry oriented. So bear with me if some of this terminology is not natural to all of you. Many stakeholders stated that they find the current non-PCD, that stands for Purchased Credit Deteriorated accounting model, to be unintuitive. That is, there is a perceived double counting of credit losses for assets classified as non-PCD, and then they also are subjected to the CECL accounting. Stakeholders also expressed concern about the blending of credit losses and interest income. So this was a presentation matter for assets that were classified as PCD. The process for distinguishing PCD assets from non-PCD assets is difficult to understand. It results in a different presentation, and it can be inconsistently applied. Therefore, we issued an exposure draft for public comment last June, and the proposed amendments are meant to address the feedback received as a result of these comments. The board is in the redeliberations phase of those proposed amendments, and during the redeliberations that have taken place to date, some key tentative decisions have been made. These include, but are not limited to, requiring all financial assets to be accounted for using the gross-up approach. The purchased financial assets accounting model must be applied to all acquired financial assets, with certain exceptions in the seasoning criteria used to classify assets in the scope of purchased financial assets. All financial assets in a business combination are to be deemed as seasoned. So what this is in essence trying to do, if I may branch off for a minute and try to use a little bit of plain English, is it's trying to remove that separate categorization of a PCD model and a non-PCD model and ensure that all purchased financial assets, and we're primarily talking about loans, that they are reflected in the same manner, irrespective of whether they were considered to be deteriorated credit or not. So we are still in the process of the deliberation. While that's not yet final, and there will be more information about that amendment to the standard, it's worth highlighting now because I think it's an indication of the benefit that we receive from the feedback through the PIR process. And hopefully we're trying to timely respond to that. So with those comments, I think I have filled everyone in on where we stand with those three current PIR projects. And now I'd like to turn things over to Jeff Gabella to talk a little bit more about the credit losses standard.
Great, thank you, Marcia. So yeah, we're sort of going backwards a little bit here to the actual CECL standard itself and what it is. So it's ASU 2016-13 that was issued back in 2016, so it's almost 8 years ago now. It is now effective for private companies and not-for-profit entities for calendar year 2023 and fiscal years beginning in that year. So we should be seeing now the final wave of adoption for all of those entities at this point, maybe by the end of of this year, let's say. And it's a broad-based standard, meaning that it is applicable to all entities. It covers trade receivables and contract assets under Topic 606 revenue, certain lease receivables and financing receivables, loans and debt instruments not measured at fair value through net income, and certain financial guarantee contracts and loan commitments. It is also applicable to programmatic loans, which we'll get to of not-for-profit entities, which we'll get to in another slide. It does not cover what contributions receivable, pledges receivable, and most grants receivable are not in scope because there is no credit component to those types of transactions if they're following the contribution model. And also loans and debt instruments measured at fair value through net income also would not be in scope. So on the next slide, there's a couple of staff Q&As. They've been out there for a few years now. So the basic premise of CECL, which I didn't mention on the previous slide, is that you are recording an allowance for credit losses on day one, based on the amortized cost basis of that receivable. And so it's an allowance account. So you're going to be recording, debiting credit loss expense and crediting a contra account allowance. And that allowance could go up and down depending on facts and circumstances. And you could also have expense in a given year or a reversal of expense. And in determining that day one loss, you're looking at your historical loss information. You're adjusting it for current conditions and reasonable and supportable forecasts. And then after that reasonable and supportable forecast period, whatever it is, however long that reasonable and supportable forecast period is, you will then revert back to your historical loss information. So these two staff papers, which are not GAAP, but they are staff papers which explain GAAP in a little bit of a different way, help you to understand some of these concepts. So the one on the right that was issued in July 2019 was a general Q&A on how to apply CECL, how to apply these concepts of historical loss information and looking at reasonable and supportable forecasts, etc. The one on the left was issued in January 2019, and that's on a specific method. And now CECL does not prescribe any specific method for calculating credit losses, but it does require that you follow the principle of that you look at historical information adjusted for current conditions and reasonable and supportable forecasts. And so this paper looks at the WARM method, the weighted average remaining maturity method, and whether and if or if it could be adjusted to also have applicability or could be used under CECL. So on the next slide, we have the effect on trade receivables. And this is probably where the majority of nonprofits would be, except for programmatic loans, would be here. Also private companies as well. So essentially what you're doing is you're going to not be changing some of the things that you do. You're going to be looking at your history of payment. You're probably going to be aging your receivables in various buckets. But again, you must look at the current conditions and the forecast for the foreseeable future. And there are going to be some additional disclosures. And then there's the issue of programmatic loans that are granted by non-for-profit entities. There is a chapter in the AICPA Audit and Accounting Guide that I think it's chapter 8. And that chapter is an example in there on how to apply the credit loss, the old credit loss guidance. It will now be updated for CECL. That's not a FASB document, so we just review that. So I anticipate that that's going to be coming out in the near future, but stay tuned for that. And then on the next slide, we have an example. So this example, the caveat, we've just changed kind of the name of the entity, that we made it a not-for-profit entity just for ease of reference for our audience today. But it is really the numbers and everything are taken from paragraphs 32620, 5537 through 5540. So if there's anything you don't understand or you miss here, you could go back and refer to those paragraphs in the codification for the numerical analysis. So again, it's historical information. You're adjusting. Oh, could you go back? Sorry. So you're looking again. I'm repeating myself. You're looking at historical information adjusted for current conditions and a reasonable and supportable forecast. You're going to be pooling your assets based on similar risk characteristics, whatever those risk characteristics are, such as customer credit rating, receivable aging category, industry, geographic location, or product line, and any individual assets that don't meet a pooled characteristic that they're sort of individual. You would assess those individually. Next slide, please. So this is the example, and we've used a membership non-for-profit organization that looks at its receivables from its members. It's really just doing a days past due analysis. Historically, what percentage of receivables have been following historical credit loss percentages. So as time passes, as you would expect, there's a higher percentage of loss. So then on the next slide, we have the example. So this example sort of looks at, the historical loss information as a reasonable base. They've analyzed that unemployment in the region of this membership organization has decreased. So they expect that historical losses will actually decrease. And they estimated based on a 10%. And so 10% in each sort of bucket here, time bucket. So you would adjust the credit loss rate percentages of each item here, each past due item. So you'd very likely have a reversal of expense in this case because your credit loss, your allowance would be decreasing in this case. So I think that's it for me. I think that we go to a polling question next.
We do. Thanks, Jeff. Thanks for walking through that example. We can now launch polling question number 5. Thank you. It asks, what is the effect on the financial statements of private companies and not-for-profit organizations when applying the credit losses guidance to trade accounts receivable and contract assets? A, have you observed a material effect? B, not material. C, still in the process of determining the effect. And D, not applicable. Just a heads up, in the next section of the webcast, one of the areas that David will talk about is the PCC agenda priorities, and a couple of people have already mentioned that. And as part of that, he will talk about an issue that was raised by the Private Company Council and private company stakeholders in applying the credit losses guidance to trade accounts receivable and contract assets. And at the March 2024 NAC meeting, we also had the same sentiments received from NAC members. So we do have a few questions in the queue. At this time, are there any questions that speakers would like to address?
Jennifer, I can take one of the questions that we've received. So the question was, do you see differences in revenue recognition by private companies versus public companies? Well, since the same 5-step model applies to both types of entities, there really shouldn't be differences in revenue recognition. Now, there were some items of relief that were given for private companies in terms of disclosures. So there are certainly some differences in the disclosures that are provided by those two groups. And as far as my recollection of the feedback that we've received from the staff, that they did observe some of those practical expedients and some of that relief being taken by private entities in their disclosures. Now, the one place where there might be some difference would be on the reporting of revenue by franchisors, because we did issue ASU 2021-02 that provided a practical expedient for franchisors and their revenue recognition. And the last thing I would say is that there's been quite a bit of similarity in the feedback that we've gotten from private entities and public entities with respect to the pain points that they still have. And those were the ones that were listed on the slide that Jennifer put up in the polling question earlier. So principal agent, short cycle manufacturing, those sorts of issues are difficult, and they're difficult for both public and private entities.
Thanks, Christine. Looks like we have almost everyone that has responded to the polling question. So at this time, you can close that polling question. Great, thank you. And now with that, I'm going to turn it over to David to talk about PCC activities and private company efforts. David, over to you.
Thank you, Jennifer. In this section, we will discuss the PCC, its activities, and other private company efforts, including current PCC members, the PCC's role and responsibilities, PCC town hall and liaison meetings, the agenda priority process, and the FASB's recently completed project on profits interest, as well as how to stay in touch with the PCC. Moving on to the next slide. Now, the PCC is comprised of financial statement users, preparers, and practitioners, all of whom have a focus on private companies. According to the current operating procedures, the PCC can have between 9 and 12 members. Currently, we are maxed out at 12. The PCC is led by an independent chair, meaning that the PCC is not led by someone within the FASB or the FAF. Jerry Shaver is the current PCC chair, and his term started on January 1st of this year. Other than the chair, members are appointed on an initial 3-year term and are eligible for reappointment consideration by the FAF for a second 3-year term. The PCC chair can be appointed for aggregate consecutive terms not to exceed 8 years. The PCC has 4 meetings a year. Typically, 1 meeting is held virtually, and the other 3 are held at the FASB's office in Norwalk, Connecticut. Next slide, please. The PCC has several primary roles. First, the PCC spends a considerable amount of time advising the FASB. In fact, the PCC serves as a primary advisory board to the FASB on private company accounting matters. In recent years, the PCC has provided a significant amount of advice to the board on major standards, such as revenue, leases, and credit losses, not only during the development of those standards, but also advises the FASB about the benefits, costs, and challenges in implementing the standards, while also advising the FASB in connection with the post-implementation review projects that were discussed earlier in this webcast. The PCC also advises the FASB on current projects, including, for example, accounting for government grants and the accounting for and disclosure of software costs. The PCC also discusses current issues in financial reporting. Second, the PCC can set its own agenda, and in doing so, identifies, deliberates, and votes on proposed GAAP alternatives for private companies, again, subject to FASB endorsement. In just a moment, I will talk more about this as I discuss our current agenda priority process. The PCC uses the FASB standard setting process for its own agenda projects, but again, decisions made by the PCC must be considered by the board for endorsement. It is an extensive process. Therefore, the PCC must be very selective in adding projects to our agenda because of the frequency in which they meet and the rigorous due process that must be followed. Another primary role of the PCC is outreach. The PCC has several liaison and town hall meetings each year. These meetings are important because they allow the PCC to solicit feedback from private company stakeholders on emerging issues, provide up-to-date information on standard setting affecting private companies, understand the needs of private company financial statement users, and engage private company stakeholders in the standard setting process. Last week, the PCC held a town hall style session at the Engage conference. We had a chance to interact with the stakeholders to get their perspective on a variety of issues. Earlier this year, the PCC met with the Institute of Management Accountants, or a Small Business Committee, and talked about financial reporting issues stemming from a range of business pressures that private companies are currently facing. Later this year, the PCC will hold a joint meeting with the AICPA's Technical Issues Committee at the FASB's office, and the PCC will also plans to have a liaison meeting with the Auditing Standards Board Audit Issues Task Force. The PCC typically meets with members of the Risk Management Association on an annual basis, which gives us an opportunity to learn about private company issues from a user perspective. Feedback that is received at the town hall and liaison meetings are then discussed in each PCC meeting. Now, before we move on to the PCC's agenda priority process, we have our next polling question. I will now hand it back over to Jennifer to take us through the polling question 6.
Thank you, David. Okay, can we please launch that polling question? Thank you. It asks, have you interacted with any current or former PCC members at a previous town hall or liaison meeting or other conferences or venues? A, yes, D or B, no, and C, not sure. So at this time, are there any the presenters that would like to address participant questions?
Hi, Jen. This is Jeff Mechanic, and again, it's great to be with everyone here today. I'd like to respond to the question that we received about tuition contracts. You may recall that when we were talking about the post-implementation review of the RevRec standard, we reported out that there was some that NAC member, a couple NAC members had mentioned that there was diversity in practice in the recognition of receivables and contract liabilities by independent schools for certain tuition contracts, with some schools recognizing both, other recognizing neither when the tuition contract relates to future periods. This was raised in the context of private K through 12 schools, but I will say that this issue was raised to us in a technical inquiry by the National Association of College and University Business Officers, NACUBO, a few years ago after the RevRec standard came out. I'll say that there isn't a lot of guidance on when to record a receivable as opposed to when to recognize revenue. And again, NACUBO asked us about this. And I think the upshot is that it really depends. It depends on the facts and circumstances of the tuition contract by the university, or in this case, by the school, with the parents and students, and particularly as to when the organization is entitled to bill for tuition. And I think in connection with that, NACUBO put out some non-authoritative guidance for members on their website after meeting with us and talking about this several years ago. So again, answer is it depends.
Thanks, Jeff. Okay, I think we can go ahead and close that polling question. Looks like the majority of you have not interacted with PCC members in the past, so I guess we have a lot of opportunity to meet with you, perhaps at conferences or different speeches around the U.S. So with that, David, back to you.
Thank you very much. So moving on to the PCC agenda priority process. Now, earlier this year, the PCC began undertaking a more structured process to evaluate its agenda priorities. The structured process is intended to increase the PCC's efficiency and benefit stakeholders by prioritizing the most pervasive financial reporting issues for private companies. Private company stakeholders, in collaboration with PCC members and FASB members and staff, identified 16 issues for initial consideration. In April, the PCC members evaluated those 16 issues and preliminarily identified 4 of those issues for further research and consideration. First was credit losses, as to whether applying CECL to short-term trade, accounts receivable, and contract assets. The next was debt modifications and extinguishments guidance. Next was revenue, as relates to the presentation of conditional retainage and overbillings as contract assets and liabilities. And the fourth was leases. During the upcoming June meeting, the PCC is expected to reconfirm whether they want to move forward on the 4 issues, or a subset of those 4 issues. I will now expand a little bit on each issue I just mentioned, starting with credit losses. Now, early in this broadcast, or webcast, Jeff mentioned that trade receivables and contract assets recognized under Topic 606, revenue with contracts and customers, are in the scope of the CECL guidance. Now, in recent months, non-financial, non-public entities have questioned whether the benefits of applying CECL to trade AR and contracts assets justify the costs. For example, trade AR tends to be short-term in nature, and the amount collectible is often largely unaffected by either macroeconomic conditions or the time value of money decay. Therefore, stakeholders are not clear how to measure CECL allowance for credit losses for trade AR using a discounting method that incorporates a reasonable and supportable economic forecast. Additionally, private company preparers and practitioners have indicated that the financial statement effect of applying CECL to trade AR and contract assets has generally not been significant. Based on this feedback and other feedback, the PCC would consider researching a private company practical expedient or alternative pertaining to the application of CECL to short-term trade AR and contract assets. For example, the ability to use historical costs to estimate credit losses without the evaluation of reasonable and supportable forecasts. Now, on to debt modifications and extinguishments. During the September and December 2023 meetings, some PCC members expressed the view that applying the guidance of subtopic 470-50, debt modifications and extinguishments, can be complex and costly when transactions involve multiple lenders. These PCC members questioned whether the benefits of the different reporting outcomes justify the costs of applying the guidance. Additionally, in its response to the board's 2021 invitation to comment, the ICPA's Technical Issues Committee stated that a private company alternative aimed at simplifying the debt modification guidance and increasing its understandability for private company financial statement users would be beneficial. The TIC encouraged the PCC to research this issue at that time. The PCC would consider a practical expedient or private company alternative that would decrease the cost and complexity of applying the guidance, while considering the information needs of private company financial statement users. For example, some PCC members suggested providing private companies with the ability to bypass the required evaluations and account for the transaction as a debt extinguishment. Additionally, some PCC members have questioned whether it is necessary to have different guidance for term debt and line of credit or revolving debt arrangements when we're evaluating debt modifications and extinguishments. Next, a little bit of insight onto the issue of presentation of conditional retainage and overbillings as contract assets and liabilities. Some private company stakeholders noted that Topic 606 changed the presentation of retainage in the construction industry. Retainage is an industry concept rather than a GAAP concept, and is usually referred to a portion of consideration held back by the customer until project is complete. For example, a company may invoice a customer 100% of the contract fee, but the customer pays 95% and holds back the remaining 5% until a later date. In practice, retainage should be appropriately classified as a receivable, classified as a contract asset, or it could be allocated between the two, depending on the terms on which the right of consideration is considered conditional. Before the adoption of Topic 606, practice presented conditional retainage separately from billings in excess of cost. Under Topic 606, conditional retainage is required to be netted with related contract liabilities on the balance sheet. Some stakeholders have suggested that grossing up the balance sheet, rather than netting the contract assets and contract liabilities, or providing additional disclosures about conditional retainage and billings in excess of cost for the construction industry, would provide better visibility into the retainage for financial statement users. Finally, with regards to leases, PCC members have expressed the view that certain areas of guidance in Topic 842 can be costly and complex to apply. Accordingly, while Topic 842 already provides some relief for private companies in certain areas, several PCC members have indicated that additional simplifications, such as practical expedients or alternatives for private companies, should be considered. This issue remains open for discussion and identification of simplifications. Later this month, at the upcoming PCC meeting, the FASB staff is going to present preliminary work plans for the issues identified above. These PCC meeting materials will be posted on the PCC's webpage several days before the June meeting. Moving on to the next section on the recently completed profits interest project. The FASB's Profits Interest Project serves as a great example of the PCC's advisement to the FASB. This project began as a PCC research agenda, which was then recommended to be added to the FASB's technical agenda. The objective of the project was to clarify and improve existing guidance and demonstrate how to apply the scoping guidance of Topic 718 to awards of profits interest. The project aimed to reduce complexity in determining what guidance should be applied to account for awards of profits interest and reduce the existing diversity in practice. To address this issue, the board added implementation guidance, including 4 fact patterns to demonstrate how an entity should apply the scope guidance in Topic 718. I will talk more about the examples in the next slide. Now, this guidance becomes effective for public business entities for annual periods beginning after December 15th, 2024, and for all other entities for annual periods beginning after December 15th, 2025. Now, this ASU allows 2 choices for transition. Either the first, of retrospective to all periods presented in the financial statements, or second, prospectively to awards granted or modified on or after that date at which an entity first applies the amendments. Again, early adoption is permitted. Next slide, please. As mentioned on the previous slide, the amendments allow an illustrative example with 4 different fact patterns to demonstrate how an entity should apply scope guidance of Topic 718 to determine whether a profits interest award should be accounted for in accordance with Topic 718. These fact patterns represent several of the most common scenarios that exist in practice today. In summary on these, the scope guidance in paragraph 718-10-15-3 states that amounts are based, at least in part, on the price of the entity's shares or other equity instruments, or the awards require or may require settlement by issuing the entity's equity shares or other equity instruments. In the example that is included in the new recently issued ASU, in cases A through C, the awards are considered to be within the scope of Topic 718. In case D, the awards is not within the scope of Topic 718. With these 4 cases, this should provide a good cross-section of how to determine what accounting guidance should be applied. Additionally, the final ASU amended that scoping paragraph that I just mentioned to improve the overall clarity and operability. Now, next slide, please. Included on this slide is a link to the PCC's section of the FASB's website. On our website, you will find our schedule for upcoming meetings, material for past meetings, and much more. Also included is a link to contact the PCC and the PCC coordinator's email. Again, please feel free to reach out to us. With that, I will now hand it over to Jeff to talk about the Not-for-Profit Advisory Committee.
All right, thank you, David. And again, great to be with all of you here today. So our Not-for-Profit Advisory Committee, or NAC, functions as the primary advisory group to the FASB board and staff on behalf of the not-for-profit sector, just as the PCC does on behalf of the private company sector. I know Jen mentioned that earlier, and also, reiterated that the NAC was formed before the PCC. The advice that the NAC provides encompasses implementation matters for new and recent standards, potential changes to GAAP being considered in current FASB projects, and other matters in the not-for-profit financial reporting environment that could warrant our attention. And indeed, the NAC has all 3 of these areas as standing agenda topics at its meetings. For example, we've already heard some of what some of what we heard from the NAC during our PIRs for the RevRec and LESIS standards. Now here I want to focus on our most recent discussion with the NAC on the current financial reporting environment. But before I do so, just a little bit more about the NAC. Let's move on to the next slide. The NAC currently consists of 18 members listed on this and the next slide. Roughly 1/3 of them are from public accounting. About 1/3 of them are from industry, always someone from higher education and from healthcare. And then we rotate through the various other subsectors within the not-for-profit sector, including cultural, religious, social service, environmental, and other organizations. And the final 1/3 are users of not-for-profit financial statements, including grantors, lenders and creditors, and an academic. Some of these users are both preparers for their own organization's financial statements, as well as users of the financial statements of grantees and potential grantees. Let's move on to the next slide. We also have observers at the table from the AICPA and from the state charities regulators, and it's this mix of perspectives of all of these members and observers that makes for a rich dialogue at our meetings. Let's move on to the next slide. One of the standing agenda items, as I just mentioned, at NAC meetings is trends, concerns, and observations about the not-for-profit sector. Basically, what's on their minds, what do we need to be aware of, especially matters that could have financial reporting implications. Now, similar to what we've been hearing from other advisory groups, including the PCC, much of the conversation here at the most recent meeting in March, actually really the last couple of meetings or so, has focused on the range of business pressures affecting the sector and the consequences of those pressures on operations and financial reporting. These pressures include staffing shortages, delayed and declining COVID financial assistance, and various fundraising and other challenges. And indeed, during the March meeting, we also talked about, for the first time, some of the opportunities and the risks posed by the use of artificial intelligence in the not-for-profit sector. Now, staffing shortages have been especially troublesome in a number of ways that are listed in the middle column of this slide. Given this tricky operating environment, NAC members continue to stress the need for transparency in the financials and notes through required and perhaps even voluntary disclosures. Now, many of you may remember those COVID-19 notes that we had for many, many not-for-profit organizations for a couple of years during the height of the pandemic. Certainly, there was a lot of required disclosures, but required information in those disclosures, but there was also a bit of voluntary information trying to be transparent as well. The NAC members also suggested that perhaps greater transparency could be achieved by the use of an operating measure in the statement of activities, which, as many of you know, is voluntary under GAAP, as well as flexible, as long as it's as what's within the measure is transparent either on the face of the statement of activities or in the notes. And for some not-for-profits, NAC members suggested that it may even make sense to consider some further transparency through vehicles outside the GAAP financials, such as management's discussion and analysis. Again, that's outside of GAAP, to provide some more context for what's in the GAAP financials. So this was the conversation we had about the financial reporting environment and things that folks in the sector should be thinking about in their financial reporting. Now, before I move on from the realm of not-for-profits and talk about the Accounting for Government Grants to Business Entities project, I'll turn it back to Jen for our next polling question.
Thanks, Jeff. Please launch polling question number 7. And it asks, what do you think is the most significant business pressure facing not-for-profit organizations today? A, fundraising challenges. B, delayed or declining COVID-19 financial assistance. C, staffing shortages. D, inflation. E, all the above. Or F, not sure, or some other business pressure that's not listed. Wanted to see if any of the presenters had any questions or comments they would like to add at this time. And if not, we will pause. There certainly are a lot of challenges facing not-for-profits today.
Jen, I could perhaps add one thing, which is just touting that we had recently redesigned the website for the FASB. And we've heard from folks who've been to the website over the last couple of months that at least they found it to be a bit more user-friendly, a bit more navigable. So I really encourage folks to avail themselves of our website and all the good things that are on it, and maybe they'll agree that it is actually improved, we'll say.
Thanks, Jeff. I know as a FASB staff member, I agree with those sentiments. I think the navigability of the website is much easier. So, good job for improving that. Okay, we still want to give some more time for participants to respond to that polling question. Keep your responses coming in, please. Okay, just another 10 seconds and we'll close it. Okay, I don't really see any additional movement in that polling question, so we will close that. Thank you for those responses. So Jeff, I'm going to turn it back to you.
All right, thanks, Jen. Let's move on to the next slide. And actually, we'll go on to the next slide beyond that. And so the first of the technical agenda projects we're going to discuss is the one on the accounting for government grants to business entities, which we've talked about in some past semi-annual webcasts. Those of you who were with us for those webcasts may recall that this is an area where there's a long-standing hole in US GAAP, with companies generally accounting by analogy using either the international guidance contained in IAS 20 or the contributions guidance in subtopic 958 that not-for-profits follow for grants regardless of source, and that businesses must follow for grants from non-governmental sources such as private foundations. The board issued disclosure guidance in this area via ASU 2021-10, codified in topic 832, to try to bring some transparency to investors on how such arrangements were being accounted for and the impact those arrangements were having on an entity's financial statements. But that guidance still left a hole in GAAP with regard to the underlying accounting itself. In the responses we received to our 2021 agenda consultation, many stakeholders supported adding accounting guidance to GAAP, with the majority of them suggesting IAS 20 as the best starting point in developing the guidance. Rich Jones, the FASB's chair, added a research project, and respondents to the invitation to comment that we subsequently issued as part of that research project provided more detailed feedback. That feedback still generally supported IAS 20 as a starting point, but also provided some suggestions for making that guidance more operational in the US reporting environment. After additional staff research and outreach, the board added such a project to the technical agenda in November of 2023, and the board completed initial deliberations last Wednesday, June 5th, and expects to issue an exposure draft within the next few months. Let's move on. I actually covered the stuff that was on this slide. Sorry about that. Let's move on to the next slide. Scope was one of the trickiest areas that we encountered during the disclosure project. And although respondents to the government grants invitation to comment provided a host of suggestions for improving the clarity and operability of the language here in IAS 20, the board concluded that it'd be better to go with more of a clean slate approach for scope. The scope that the board decided on leverages the transfer of assets from governments scope out language of subtopic 958-605, but for clarity, like IAS 20, explicitly includes such arrangements when they're structured as forgivable loans rather than initially as grants. The board further limited the guidance to monetary and tangible non-monetary assets, so for example, cash, land, buildings, and equipment, as this avoided bogging down the project with the sorts of conceptual and practical challenges posed by intangibles and services. The board acknowledges that for such assets, intangibles and so on, companies could always apply the guidance that is being developed here by analogy. As for explicit exclusions, rather than keeping the transactions in the ordinary course of business language that's in IAS 20, the board used the exchange transactions language and explicit references that are in US GAAP. Like IAS 20, the guidance would explicitly scope out items accounted for under the income taxes guidance, topic 740. Finally, as suggested by many ITC respondents, the guidance would also scope out below market interest rate loans where there already is guidance in GAAP, as well as government guarantees. Scope is an area where there is unanimity among board members in their views. Let's move on to the next slide. The accounting model itself more closely leverages IAS 20, and it's here and with some of the related disclosure decisions that board members' views are more mixed. I'll be presenting the majority view that will be proposed in the exposure draft. However, the exposure draft will also contain a few alternative views by board members. A majority of the board decided to propose IAS 20's recognition approach and only change some of the terminology for consistency with that used in US GAAP. Business entities under this approach would recognize government grants into net income on a systematic basis over the periods in which the entity recognizes as expenses the related costs for which the grants are intended to compensate, so long as it's probable that the entity will comply with the grant's conditions and the grant will be received. Now, this differs from the guidance in subtopic 958-605, where recognition is when conditions are substantially met and there's no explicit blanket tie-in to related expenses. While for many government grants, especially simple expense reimbursement grants, the end result may be similar, the timing for other grants could differ depending on the nature of the grant and the specific conditions. Move on to the next slide. The proposal would also retain much of the optionality of IAS 20 with regard to presentation. For grants related to income, that is, grants other than those that are for the acquisition or construction of assets, the grant will be recognized in the income statement either as income separately or via a deduction from the related expenses. For grants related to assets, the grant would be recognized on the balance sheet either via setting up a deferred income liability or by directly deducting it from the carrying amount of the asset. Now, that latter approach, deducting it from the carrying amount of the asset, is what some board members refer to as a cost accumulation approach, with the carrying amount only reflecting the cost to the entity itself and not any amounts subsidized by others, in this case by a governmental entity. With the deferred liability approach, the liability would then be systematically reduced, typically in the same pattern as the depreciation expense, through the income statement, either separately as income or as a deduction from the depreciation expense. In other words, similar choices to those for grants for income. With the cost accumulation approach, the lower carrying amount would result in reduced depreciation expense, thereby achieving a similar income statement outcome as the deduction from expense option if a deferred income liability had instead been set up. The board decided that, finally, the board decided that cash flows from government grants would be presented based on the existing principles in topic 230 and not to add to those as some stakeholders had suggested. Move on to the last slide here. At last Wednesday's meeting, the board decided that the topic 832 disclosures, the ones again that came into existence via ASU 2110, that were previously applicable to entities only analogizing to a grant or contribution model, would now instead apply as part of this proposed guidance that when finalized, entities would be required to follow. There are, however, a couple of noteworthy changes to that guidance, that disclosure guidance, and they are listed on this slide. The second of those changes, that when a cost accumulation approach is used for grants related to assets, business entities would not be required to disclose the impact on the balance sheet and income statement line items, will likely be a key focus of some or all of the alternative views in the exposure draft. Finally, a majority of the board decided to provide specific guidance in the exposure draft about when and how to recognize and measure grant-related liabilities in a business combination. Again, we expect to issue the exposure draft within the next few months, and stay tuned. I'll now pass it back to Jen for another polling question.
Thanks, Jeff. Please launch polling question 8. And ask, what type of government grants does your business entity or those you audit receive? A, income grants, B, asset grants, C, both, D, neither, E, not applicable. And while participants are responding, would any of the speakers like to address some of the questions that have been received?
I can address one of the questions that came in. So the question was, what is the estimated timing on a proposed ASU on PCD assets? So the exposure draft on that proposal actually went out June 27th of 2023, so last summer, with a comment period end date of August 28th, 2023. And we did receive approximately 35 comment letters. Right now, the board is in the process of redeliberating the proposal on the basis of the feedback that we've received. And I would say that at this point, we don't really have a good idea as to what the date will be when a final ASU is issued. But I personally would not anticipate that that project will be finalized before the end of the year. I'm just not quite sure when in 2025 you might expect to see that guidance come out in final form. And Jennifer, if we've got a few more minutes here for a pause, I just wanted to make sure that everybody is aware of some of the changes that are happening in the board's membership. We are going to be very sorry to say goodbye to Jim Croker on June 30th, 2024, when his 10 years as a board member comes to an end. But we will be very happy to welcome Hillary Salo to the board. She will be coming to us with a public accounting background. And if her name sounds familiar, that's because she is currently the FASB's technical director. Since she'll be moving from the role of technical director to the role of board member, of course, we needed to fill Hillary's post as technical director. And so we are welcoming Jackson Day. Jackson is a partner at EY presently. And so Rich and Jack know each other quite well, having worked together for quite a few years in the past at EY. Jack is a past deputy chief accountant at the Office of the Chief Accountant of the SEC. And for a time, he was also acting chief accountant. He's also a past practice fellow, and he previously served on the EITF. So he's coming to us knowing this organization quite well.
Thank you, Christine. And with that, I think we can close out that polling question. And now I'm going to turn it over to Jeff G. to talk about statement of cash flows.
Okay, thank you, Jennifer. Yes, next slide, please. So yeah, the statement of cash flows, this is actually really two projects now. We have, and there's a little bit of a history on this. So basically the invitation to comments that was issued in 2021 provided a feedback from a number of stakeholders that asked us to address many different issues in the statement of cash flows, certain classification issues and better connectivity between reconciling changes in the balance sheet and the statement of and changes in those same line items in the statement of cash flows. That feedback now has been sort of split into two projects, and one is a statement of cash flows for financial institutions, and then we have a general research project to continue to explore further improvements to the statement of cash flows. So the project that's on the technical agenda was added at the November 8th board meeting, and what we've heard in the past from stakeholders and from investors and others is that there's one statement of cash flow format for all entity types. And so it would make, and a lot of those categorizations don't necessarily make sense for a bank. For example, the granting of loans is included in financing activities, while taking deposits is an investing activity. Loans are investing, and taking deposits as a financing activity, when those are really part of the core operating activities of a financial institution. And so it would make sense to reclassify some items essentially from investing and financing up to operating. So it would grow, the operating section would essentially grow. And this would provide users with additional decision useful information. So the project is going to focus on financial institutions. And so when I say that, we're really at the beginning stages of this project. So in our initial outreach when we were doing this as a research project in talking to investors, we were broadly using the term financial institution and bank interchangeably without definitively saying which entities would be in scope and which entities would not be in scope. So that's part of the project now. A second piece of the project that the board asked us to look at was disclosure of an entity's cash interest income received. So that issue is that today under GAAP, all entities are required to make a cash interest paid disclosure. And so what we heard from some investors is that cash interest income received, especially for financial institutions, but would provide a sort of this cash net interest income would be a very useful piece of information for investors to have, because very often they don't don't have insight into what is accrued and what has been received, what's been accrued interest versus what is cash interest. So that is another piece of this project. And then the board so the next steps are really to determine which entities are going to be in scope, right? Which banks would be in scope, would be required, to follow a different format. We're also going to look at some potential subtotals within operating, because the operating section would become very, very large, looking at whether we would have a separate subtotal for investments related to net interest income, for example. And then also look at revised definitions of investing and financing activities for those entities that are in scope. And so I guess the question, the main question for you all is whether private company financial institutions would be in scope. And it's way too early to tell that at this point. I mean, all financial institutions, which I should use in air quotes, are technically in scope now, and we will work through all of those issues as we develop all the different aspects of this project. And so I would say stay tuned for this, and also stay tuned for our general project on the research agenda. So now I think I'm turning it over to Jack to cover software.
Great. So I will now discuss the project on the accounting for and disclosure of software costs. So the next slide provides several examples of common types of software, such as mobile phone applications, databases, and enterprise resource planning systems. Many companies provide services to their customers through software, such as online banking, online shopping, and online games. Many companies also embed software into tangible items, such as network equipment, cars, household appliances, and industrial robots. Additionally, companies directly sell software to customers through on-premise licenses or through cloud computing arrangements. Therefore, virtually every company is affected by the accounting for and disclosure of software costs. It is important to note that software costs currently fall under two different subtopics: costs incurred to develop or purchase software that is solely for an entity's internal use, costs incurred to develop a hosting arrangement platform, and costs incurred by a customer to implement a cloud computing arrangement would be accounted for under subtopic 350.40. Subtopic 350.40 separates the development of internal use software into three stages, which are the preliminary project stage, the application development stage, and the post-implementation or operation stage. The accounting treatment for software costs varies under each stage. During the preliminary project stage, costs are expensed as they are incurred, while during the application development stage, eligible costs are capitalized. During the post-implementation stage, cost capitalization ends and asset amortization begins. Additionally, during this stage, only upgrades and enhancements are capitalized, while other costs, such as maintenance costs, are expensed as incurred. The current guidance under subtopic 350.40 was written to reflect the way that companies have historically developed software using what's known as the waterfall method. The waterfall method is described as a prescriptive, sequential, and formal process. While the waterfall method may be suitable for certain software development projects, it has also been criticized for not being able to adapt to changes in software requirements. Software continues to evolve, which has resulted in new types of software development methodologies, such as the Agile method. The Agile method focuses on incremental and iterative development that allows software projects to adapt and respond to changes in requirements. Within the Agile method, a software project is broken down into shorter timeframe development efforts called sprints. This iterative environment makes the software project more manageable and allows for companies to quickly incorporate changes. However, some stakeholders find it difficult to apply the more prescriptive sequential guidance in subtopic 350.40 to their software development when using more iterative development methods such as the Agile method. The other subtopic that software costs may fall under is subtopic 985.20. Costs incurred to develop software to be sold or licensed to customers would be accounted for under this subtopic. Additionally, costs incurred to develop software used in a hosting arrangement would be accounted for under this subtopic if certain requirements are met. For example, if the customer can take possession of the software without significant penalty. Subtopic 985.20 considers the threshold of technological feasibility for the costs associated within the development of software to be sold, leased, or marketed. Software development costs are expensed as incurred until the software reaches the capitalization threshold of technological feasibility. Technological feasibility is not defined in the master glossary, but subtopic 985.20 notes that the completion of either a detailed program design or a working model is evidence that technological feasibility has been established and that capitalization of costs should begin. Once a software project is available for general release, capitalization ends and software development costs that have been capitalized should begin being amortized and should be assessed for impairment. Maintenance costs are expensed as incurred. To address changes in the software development process and to address the need for more disclosure about software costs, the board added a software project to its technical agenda in June of 2022. In the first half of 2023, the board decided to no longer pursue an ongoing development cost model, an expense all model, or a dual model. Instead, the board directed the staff to conduct further research and analysis on a single model. At a board meeting in September 2023, the board considered key recognition aspects within a single model. Also at this meeting, the board directed the staff to perform targeted investor outreach and to explore what targeted improvements could be made to the current guidance. Earlier this year, in March, the board decided to pursue targeted improvements to subtopic 35040 rather than continuing to pursue a single model. The board also directed the staff to explore additional disclosures or amendments to existing disclosures that could improve the guidance. Finally, the board decided to retain the recognition and measurement guidance in subtopic 98520. On the next slide, I'll talk a little bit more in detail about the targeted improvements to subtopic 35040. As a reminder, the amendments on this slide are tentative and subject to change at future board meetings. On June 19th, the board will meet to redeliberate the following decisions, and detailed tentative board decisions will be posted on the FASB website. The first targeted improvement pertains to software with unresolved high-risk development issues. Under the tentative draft amendments, the cost of software that have unresolved high-risk development issues, for example, software that has novel, unique, unproven functions and features or technological innovations, would be accounted for as research and development expenses in accordance with subtopic 730.10. Once the high-risk development issues have been resolved, future software costs are then subject to the guidance in 35040. The next targeted improvement aims to address the complexities of applying subtopic 35040 to agile development methods. If an entity determines they are in a nonlinear production cycle, they will no longer be required to evaluate if the project is in the preliminary project stage or application development stage when determining the starting point for capitalization. Instead, that entity should consider if there is significant unresolved uncertainty associated with development activities. When there is significant unresolved uncertainty, it is not probable that the project will be completed and the software will be used to perform the function intended. As such, costs should not be capitalized until the significant uncertainty has been resolved. If an entity determines they are in a linear production cycle, the targeted improvement previously discussed will not apply. In terms of the next steps, the board is expected to consider disclosure and transition requirements later this month, and an exposure draft is expected to be issued in the third quarter of this year. I will now turn it back to Jennifer to take us through polling question number 9.
Thanks, Jack. Please launch polling question number 9. It asks, does your private company or not-for-profit organization or those you audit have experience with applying the current guidance in subtopic 350-40, which is the internal use software, or subtopic 98520, which is the external use accounting guidance on accounting for software costs? A, yes to both, yes to topic 350-40, B, yes to subtopic 98520, C, yes to both, D, no to both, and E, not sure. Jeff, were you going to address some questions here while we're waiting for?
I am. Thanks, Jen. We did receive a couple of questions that are actually very similar, and I'll just read one of them, but the other question is, as I say, more or less the same. Would accounting for grants, this has to do with the government grants to business entities project that I talked about, would accounting for grants change for not-for-profits? What about a not-for-profit that is a business-oriented healthcare entity within the scope of topic 954? If no change, what would be the justification for having two models? Well, the quick answer is that no, this would not change for not-for-profits. What we're trying to do here is to fill a hole and gap that only exists for business entities. There is no hole and gap for not-for-profit organizations. Not only is there on-point guidance in subtopic 958-605, but we actually improved that guidance to be more consistent with the RevRec standard when back in 2018 with ASU 2018-08. And indeed, as you'll read in the exposure draft, this is at the heart of Christine Bodison's, will be at the heart of Christine Bodison's dissent. Now, with regard to healthcare organizations, again, Not-for-profits who are business-oriented, not-for-profit healthcare organizations, again, would not change for them either. This was a significant topic that we discussed with the Healthcare Financial Management Association when they were in to meet with us recently. What we heard from HFMA is that certain types of users do not compare the financial statements of for-profit and not-for-profit providers, particularly those who are doing credit ratings. Those they're doing credit ratings for-profits are in the corporate bond group, and those who are doing credit ratings for not-for-profits are in the muni bond group. So there's little or no comparison. But we also heard that some other users that this comparability may be more of an issue. So we'll see what kind of responses we get. Finally, I do want to stress that for many grants, the answer is not going to be significantly different. Again, normal expense reimbursement grants. For other types of grants, however, depending on the conditions, there could be some differences. So I encourage you guys to look at the exposure draft, read it, read all the various views, and weigh in.
Thanks, Jeff. Are there any other questions that speakers would like to address at this time? If not, we've still got some. Oh, Christine, I just saw your video come on.
For some reason, I click on my video thing and it takes a few minutes. Anyway, yes, there was a few questions that came in asking if website development costs are included in the scope of the project on accounting for and disclosure of software costs. So there is subtopic 35050 intangibles, goodwill, and other website development costs that addresses the accounting for these types of expenditures. We haven't specifically talked about website development costs yet in this project. But if you watch the June 19th board meeting coming up very soon, this is one of the issues that the staff is going to be discussing with the board during that board meeting, and specifically whether we need to make any consequential amendments to the guidance for website development costs. So at this point, I would just say stay tuned.
Thanks, Christine. We can now close that polling question. Thank you. And I'm going to turn it back to Jack.
Okay, great. I'll now provide an update on the board's Accounting for Environmental Credit Programs project. So on the next slide, as a reminder, these decisions on this slide and the following slides are tentative and subject to change at future board meetings. The board added the Accounting for Environmental Credit Programs project to the technical agenda in May of 2022. The project's objective is to improve the recognition, measurement, presentation, and disclosure requirements for participants in compliance and voluntary programs that involve environmental credits and for the non-governmental creators of environmental credits. To date, the board has defined both an environmental credit and an environmental credit obligation. An environmental credit is a separately transferable right represented to prevent, control, or reduce emissions or pollution that is not an income tax credit. Environmental credits can be purchased, they can be granted, or they can be internally generated, and they may be represented by a variety of forms, including credits, certificates, allowances, and offsets. An environmental credit obligation arises from existing or enacted laws to prevent, control, reduce, or remove emissions or pollution that may be settled with environmental credits. The board has also made significant headway in determining what is in and out of the scope of the project. Carbon offsets, renewable energy certificates, renewable identification numbers, and cap and trade allowances, among others, are in the scope of this board's project. Tax credits, investments, and partnerships or other equity securities that generate credits, and environmental, social, and governance, or ESG reporting, is not in scope. The board has made decisions on both asset recognition and measurement, which is covered on this slide, and on the recognition and measurement of liabilities, which I'll cover on the next slide. The board decided that an asset should be recognized when it is probable that the entity will sell the environmental credit or use the credit to settle an environmental credit obligation. Costs of all other credits, for example, voluntary credits, which are environmental credits that are not probable to be sold or used to settle an environmental credit obligation, should be expensed as incurred. An asset should generally be measured at cost less impairment. However, credits probable of being used to settle an environmental credit obligation are not subject to impairment testing. FASB staff are currently researching a fair value remeasurement policy election for some recognized environmental credit, such as those held by traders for speculative purposes. In terms of liabilities, the board decided that an entity should recognize the liability for the number of environmental credits that would be due to a regulator, assuming the end of the reporting period is the end of the compliance period. The remeasurement of this liability depends on whether the entity owns sufficient compliance credits, which are environmental credits probable to be used to settle an environmental credit obligation. If an entity has sufficient compliance credits, they have what is referred to as a funded liability, which is measured using the carrying amount of those environmental credits. If an entity does not have sufficient compliance credits, they have an unfunded liability, which should be measured using the fair value of the credits needed to settle the obligation. As an example, please consider that an entity is obligated to remit 1,000 credits at the end of the compliance period. When the period ends, the entity has 800 compliance credits on hand with a carrying amount of $8,000. The fair value of a compliance credit is $15. The entity would recognize a liability of $11,000 and an asset of $8,000 under a gross presentation method. The $11,000 liability is comprised of the $8,000 carrying amount of credits on hand and the $3,000 fair value of the credits to be purchased to be able to settle the obligation. As mentioned on the last slide, the next steps include exploring a fair value remeasurement accounting policy election for certain environmental credits. The board is also expected to consider disclosure and transition requirements. With that, I'll now pass it back to Jennifer to take us through our 10th and final polling question.
Thank you, Jack. You can launch polling question number 10. As he mentioned, this is the last polling question of this webcast. And it asks, are you planning to participate in the December 2024 webcast, FASB update for private companies and not-for-profit organizations? A, yes, B, no, and C, maybe. We have not yet pinpointed the exact date, although in the coming weeks, we will be taking a look at our calendars. Typically, it's around, I don't know, sometime between like the 9th and the 15th of the webcast, though. Are there any questions at this time that speakers would like to address while we're waiting on responses? See a couple folks that turn their video on, so maybe.
I'll defer to David for the first one.
Thank you. I believe there's an earlier question on CECL and the application of the acquisition of financial institutions when a credit discount recorded for loan receivable in terms of when it should be recorded as to whether or not it's an acquisition entry or whether or not it's a day two. So in accordance with the new CECL guidance, I will direct you to ASC 326-10-65-1, which amended 805-20-30-4A and B, in which it does discuss the application of the credit allowance deterioration process. And first, that is part of your determination of the fair value, because that does take into account the future cash flows projected. Second, it does talk about it as being a specific adjustment in there in 4B.
Thanks, David.
So the question that I was going to address was one that came in on software costs, and it was asking, you know, what have we observed with respect to companies expensing versus capitalizing software development costs under 985-20 and 350-40, and whether the proposal would require capitalization under 350-40. So what we've observed, and the staff has done extensive outreach with preparers and auditors on both how 985-20 and 350-40 are applied in practice. And generally what we've heard is that entities that are following 985-20 generally expense almost all of their software development costs under that standard, treating them more as research and development type expenditures, whereas under 350-40, that generally entities do capitalize software development costs related to the development of software for internal use. The changes that we would be making to 350-40 are quite minor, to be honest, and certainly would not would not result in a requirement to capitalize under 350/40. Both 350/40 and 985/20 require a lot of judgment to be applied by companies to determine whether or not they're in a position of meeting the requirements to capitalize, or whether they are, still in the position of having to expense. And that judgment will not be altered at all by the changes that we're making or proposing to make.
Thanks, Christine. We can now close polling question number 10. And the last project we're going to talk about today is derivatives scope refinements. And Liz, I'm going to turn it over to you.
Great. Thank you, Jennifer. Now I will discuss topic 815, derivative scope refinements. This project came out of the June 2021 agenda consultation invitation to comment, in which stakeholders noted that there are difficulties in applying the definition of a derivative to certain arrangements. Therefore, the FASB chair added a research project to address these issues raised, including but not limited to embedded derivatives, bifurcation criteria, derivative modifications, amongst other issues. In December of 2023, the board decided to elevate one of these issues to the technical agenda, which is now the derivative scope refinements project. The derivative guidance in topic 815 requires companies to evaluate whether an arrangement as a whole meets the definition of derivative or has embedded features that meet the definition of a derivative. The derivative criteria states that a derivative has 1, an underlying, and 2, a notional or payment provision. Together, the underlying and notional amount or payment provision determine the amount of settlement or whether a settlement is required. The underlying is a variable which causes the fair value of the derivative to fluctuate based on the occurrence or non-occurrence of a specified event. The notional amount is the quantity that determines the size of the change caused by the movement in the underlying. When a contract or an embedded feature in a contract has more than one underlying, and some but not all of them qualify for a derivative scope exception, an entity must perform a predominant characteristics assessment. That assessment is needed to determine whether the contract in its entirety qualifies for the scope exception, and therefore whether it is accounted for a derivative or not, or whether the embedded feature qualifies for the scope exception, and therefore whether it is accounted and bifurcated as a derivative. Based on the current requirements, a contract is subject to derivative accounting if all of its underlyings considered in combination behave in a manner that is highly correlated with the behavior of any of the component variables that do not qualify for a scope exception. Stakeholders noted that this assessment is very difficult to apply because of the correlation assessment in practice today. Certain arrangements as listed on this slide in red could be considered to meet the definition of a derivative, although stakeholders believe that accounting for those arrangements as derivatives is not an accurate representation of the economics of the transaction. For example, an ESG-linked bond in which the coupon rate increases based on whether or not the company's carbon emissions exceed a specified threshold. In practice, this could meet the definition of a derivative, although many did not believe that it should. So moving on, the board has made some recent key tentative board decisions. Firstly, to amend topic 815 to incorporate a scope exception for contracts with underlyings based on operations or activities specific to one of the parties of the contract. This new exception would be subject to certain restrictions or guardrails. That is, underlyings based on a market rate, market price, or market index, or the price or performance of a financial asset or liability would not be captured by this scope exception. The board also decided to amend the predominant characteristics assessment and replace the correlation assessment with a fair value assessment. An entity would assess how each underlying affects the fair value of the contract and determine which underlying has the largest expected effect on changes in the fair value of the overall contract, or an embedded feature in the case of a hybrid instrument. The underlying that has the largest expected effect would be considered the predominant underlying, and whether the predominant underlying qualifies for a scope exception would then determine the accounting for the entire contract or embedded features. Furthermore, practitioners observe that there is a lack of clarity and gap on which guidance should be used first, such as topic 606, the revenue guidance, topic 815, or topic 321, investments in equity securities, should first be considered to account for a revenue contract with a share-based payment from a customer. As a result, there are different views in practice on when that share-based payment should be recognized. The firms generally supported the board's effort to clarify the accounting in this area. Therefore, the board decided that an entity that receives the share-based payment from a customer in a revenue contract would apply the guidance in topic 606. Furthermore, an entity that receives a share-based payment from a customer in a revenue contract would not apply the guidance in topic 815 or topic 321 until and unless the share-based payment is recognized in topic 606. As next steps, the FASB expects to soon issue an exposure draft for public comment. That concludes our prepared remarks for today, and I will turn it back to Jennifer. Thank you.
Thanks, Liz. Appreciate you providing an update on that project. So we just have a couple of minutes left in the webcast, and let's see if any of the speakers would like to address any other questions that have been received.
Jennifer, we had a question on CECL adoption and whether you are required to disclose that you've adopted CECL or not, if you have no impacts from adopting CECL. So I think, this is generally, the FASB would point out that you do not have to make disclosures if there is no material impact to your financial statement. So that is just a general guideline.
Thanks, Jeff. Okay, last call. Any other speakers? Would you like to answer any questions? Okay.
I can add in another one on statement of cash flows. I think one of the questions is that, would insurance companies be in, and also financial technology companies that also provide, technology platforms, but also banking type services, but may not be, a sort of list, or, may not be regulated as banks or be considered to be banks. And just to say that these are early days right now, and we're trying to define the scope of entities that would be in. And like I said before, we're just using the term financial institutions very broadly. So I would just say stay tuned.
Thanks, Jeff. Christine, I see your video's on.
Yes, I don't have a question to answer, Jennifer, but I did just want to thank all the participants for spending time with us today. And I also just wanted to reiterate that we're going to have several exposure drafts coming out over the next 6 months or so. And just how valuable the participation is of stakeholders in helping us to refine the proposals that we've made. And so I would just encourage everybody to watch out for those exposure drafts as they come out. And if you can find time, I know you're all very busy individuals, but if you have time to participate in our process, it's really, really important. And then also on the agenda consultation coming up, letting us know what you're worried about, what topics need our attention and could benefit from some standard setting. That's really important feedback for us as well. So thanks, everybody. Glad you spent some time with us today.
Thank you, Christine, and thank you to the participants of this webcast today. And we hope to see you for the December 2024 webcast. And we hope you all have an enjoyable summer. So with that, that concludes today's webcast.